Hello and welcome to another exciting episode of NSE FinWiz Season 6 powered by CNBC TV 18. I'm your host Gautam Srinivasan and we continue our journey towards educating people about financial planning and of course their investments. Our next pit stop in Pune, the offices of one of the leading global fintech providers, FIS. So let's check them out.
Founded in 1968, Fidelity National Information Services, better known as FIS, is an international provider of financial service technology and outsourcing services. Providing world-class resources and global business solutions, FIS employs around 52,000 people and has over 20,000 clients in more than 130 countries. This week, NSE FinWiz is at the FIS campus in Pune to engage with its employees on the theme Invest in Yourself, Your Path to Prosperity, and to understand their financial aspirations.
Financial literacy is the education and understanding of knowing how money is made, spent and saved, as well as the skills and ability to use financial resources to make decisions.
To me, financial literacy is having some specific skill sets which help you to manage your money. It's not about managing your bank accounts, checkbooks and spending. It's more important towards how you invest, how you foresee your future and how you work around it and how you want to achieve your future goals and maybe financial goals which you set for your future.
For me, financial literacy is like proficiency of financial planning, principles, investments, smart investments, debts and value of time and money.
Welcome to NSE FinWiz Season 6 powered by CNBC TV 18, continuing with our theme of investing in yourself, your path to prosperity. We are at the FIS campus in Pune to discuss concepts of personal finance and wealth creation with the employees here. And to help them do that, we are joined by our financial wizards, Nikhil Kothari and of course, Kalpesh Ashar joining us. So let's start with the factor of market volatility, which always puts people off. They sometimes worry about this roller coaster ride. So let's understand what makes a market volatile, first of all. Nikhil, what do you have to say about that?
Volatility basically means that every day markets may go up and go down. That's the nature of the market. But if you look at long term, what exactly determines the price is the fundamental value of that company. If the company is fundamentally making profit every year on year, then in the long term, the value of the company will go up. But in the short term, because of the buyers and sellers' different approach, in the short term, there can be a lot of news in terms of global news, in terms of domestic news, and because of that, price in the short term may go up and down. So it all depends on what exactly your view is, and based on that, you need to understand the volatility of the market and then invest accordingly. Now, volatility will again depend on asset classes. If you're looking at the fixed income as an asset class, like in debt, then the volatility will be far, far lower. But if you look at equity as an asset class, the volatility will be far, far higher.
A lot of the times, people, even if they have crossed that Rubicon of going to investments versus savings, they still look at just the returns part of it without focusing on what this money is supposed to do for them. So do you think that big behavioral shift is required? And if so, how do people achieve it?
The markets are supposed to be irrational. There are 1,000 factors which control market behavior. And nobody can predict any type of returns or any type of phase of market which will turn out to be true over and over again. So that is beyond your control as investors. What is in your control is your behavior. And when is your behavior in control? When you know for what you are investing. So the simple thought is that if investing for a long-term goal, you cannot risk your investments in an FD. Here the risk is that you won't get the desired returns because you're using a wrong product. Similarly, if you're using an equity product, be it stocks or equity mutual funds, to invest just for the 1 or 2 year period, you're taking a big risk.
All right. And with this vast universe of investment products that people have, what are some of the pointers that you would suggest in terms of gauging the amount of volatility that an average investor would be comfortable with?
The first thing is that what is my time frame of the goal? If the goal is for short term, say 1 to 5 years, then I cannot take too much of risk in terms of market going up and down. Then I should be taking a lower volatile asset. If I have a long-term goal, which is 7 years, 10 years, 15 years, then I don't mind short-term volatility. So first is that you need to determine your time frame. Second is that at what age profile you are. If you are a young investor, you can take a slightly higher risk with your earned money right now. If you are on the verge of retirement, then your steady cash flow from in terms of salaries or in terms of business income will keep on coming down or won't be there. Then in that case, the asset which you've already accumulated, you need to take a lower volatility on that asset. So depend on your age profile, depend on your time frame, and depend on which stage of income or which stage of wealth you are. All these factors determine that how much risk I can take.
All right. What kind of words of encouragement would you give to the folks here when it comes to the long-term horizon and staying the course?
We always start with a disclaimer that do not look at the past track records or something. But the fact also remains that you can't ignore the present. And for that, you have to have a financial plan in place. At the long-term returns, equity funds, over a 10-year period, I'm talking about good multi-cap funds, diversified by nature, not any particular market segment, have given a decent return of a 15% CAGR, which is not bad at all.
All right, let's see what these investment products can do for the audience here, especially with regards to your goals. First name I'll be calling out is Ishan Chatterjee, if you could get up.
My dream is to open an export house within next 5 years.
Okay, and how much amount can you set aside monthly?
Around 25K per month.
What I'll recommend is that in this time frame, you should have a mix of a debt and equity portfolio. If you look at from an investment perspective, there's a theme called as hybrid fund. So hybrid fund basically invests around 65 to 80% in equities and remaining portion in the debt. So I'll recommend that you can start an SIP in hybrid fund currently, continue to do that for next 3 to 4 years. After 4 years, look at the corpus, and at that point of time, start moving that money from the hybrid asset to a debt allocation.
All right, I hope we've answered your question. Thank you so much, Ishan. The next name I'll be calling out is Aarti Bendre.
I would like to go on a world tour after 18 years. That is after completion of my kids' education. I can set aside 25K per month.
Coming to the target, I just did a small mental calculation. So 25,000 per month is around 3 lakh per year. And 3 lakh per year for 18 years is 54 lakh rupees by default you'll set aside. Because for 18 years, equity funds is the answer. And if you give it a good, decent, conservative post-tax, now we have 10% LTCG also on equity, a good 12% type of a CAGR. I think with that type of a capital built over a period of time, you could really have a very healthy corpus in that time frame.
I think on that note, we can take a very short break. We've answered the questions the folks here at FIS had on their goals. And of course, we've been discussing investing in yourself, your path to prosperity. When we return, we'll be exploring the nuts and bolts of the fundamentals of asset allocation. And remember, you can stay updated with us on our website, NSEFinwiz.com, and of course, keep in touch with us on our Twitter and Facebook handles and at NFC FinWiz. So stay tuned. We've got lots more coming up. Keep watching CNBC TV 18. Welcome back to NSE FinWiz Season 6, powered by CNBC TV 18. Now we take a deep dive into the topic of this episode, which is fundamentals of asset allocation. Nikhil, let's start with what's the best split when it comes to assets? That's the fundamental question a lot of folks have, as in we've got so many options which are available in terms of investment. So what's the kind of best split I should look at when it comes to my portfolio? So how would you answer that question?
If I'm taking an average age of say 30 years of age, then 70% of your portfolio should be in risky asset, a high volatile asset, and 30% of your portfolio should be in debt. Now, again, as it is not a one size fits all, it all depends on your time frame. You can modify this asset allocation depending on your goal. If your goal is for long term, then you can tweak this number. Instead of 70-30, you can make it 80-20 or 90-10. If the goal is for short term, maybe say 5 years, then you can tweak it on the lower side. You can make it 50-50 in debt and equity. And if the goal is for 3 years, and you can tweak it completely different, then you can make it 70 debt and 30 equity. So you have to tweak your asset allocation depending on your time frame. But again, as a thumb rule, 100 minus your age should be your equity asset, age should be your debt asset.
All right. And Kalpesh, in terms of asset allocation strategies with volatility in focus, what are the different strategies that people could look at?
The simple rule of asset allocation means that your assets are in various proportions in different asset classes. The strategies which I would say here, which determine your asset allocation, could be two-dimensional. One is the strategic way and one is the behavioral play. Now, as far as the strategic way of asset allocation goes, is as simple as that you have a goal, you want to reach it. How much time do you have on your hand determines which asset would you be investing in it in a major basis. So you don't have anything coming up in the next 10 years for sure. Equities would form a major component of your asset allocation. If anything is coming up in the shorter time frame, debt would have a little bit of a prominence there. We also have other asset classes, which are gold, which also goes into real estate at some times. But gold, as we all know, is more of an emotional asset class we all invest in. We have seen the returns. The returns have not been fabulous at all. Real estate has got its ifs and buts. So we always suggest that assets should be one which are in financial assets, which are easily liquidable, easily measurable, and they should serve the purpose for which you are investing.
All right, and Nikhil, but when debt funds don't perform up to mark and when people still have a defensive investment strategy, so what are the options? Top up SIPs to take advantage of rupee cost averaging. What should they do?
Even in debt, you can do a fixed deposit, like it's a safe asset where the returns are guaranteed, okay? But there you have an element of taxation. So taxation is, from a tax-friendly, it's not a tax-friendly investment. Then people look at debt mutual fund. Okay, and at times, debt mutual fund would have underperformed an FD in a short period of time. But again, when you look at from a 3-year perspective, they are more tax efficient as compared to an FD investment. Now, what we say that if at times, say for example, you have invested in an asset class and which is not performing in line with your expectation. So the reason may be that markets are down slightly, and because they have underperformed. But if you have a longer time frame, if you have a still time to go, then first thing you can continue to hold that investment. So at least if you have a time in hand, then you can, and there's a philosophy of mean reversion. So it will again revert to the mean. And second, the good thing which you can do is that if you have an additional fund at that point of time, you can invest that point of time and do an average cost.
All right, and before we go to the audience for questions, Kalpesh, what are some of the do's and don'ts of rebalancing a portfolio to keep up with volatility?
I think the only time your rebalancing should be done when your goals approach. Because there will be times through this entire journey when you tend to get carried away or you tend to get anxious. You need to, calm your nerves and see where you are right now, what is your position and where your goal is. Playing around with your portfolio or making it look better, I think it's a very delicate thing and better done with the help of a professional.
All right, so that's the expert's view when it comes to the fundamentals of asset allocation. Let's go to the audience now and see what questions they have around this topic. The first name I'll be calling out is Vinita Athanikar, if you could get up.
I already am investing certain amount of money with an investment portfolio manager, and he's taking care of the retirement. But I also have travel plans, and I don't want to wait till my retirement to do these. So if I want to save for that, so how do I invest? Where do I start? What is the best plan?
My suggestion to that would be to use the most important component of a financial plan, which is your cash flow. Visit your cash flow again. And the goals which are being already targeted through these regular investments for the long term, don't touch them. From that amount, whatever you can set aside on a regular basis, invest that amount in a short term or a liquid fund.
Thank you for asking a question. The next person I'll be calling out is Pavan Udasi, if you could get up.
My question is, if I start investing, let's say for 10 years, and I decide after 10 years I don't have to work and I just want my money to take care of all my expenses. So what is the plan for that?
So you have to look at two angles. First is your accumulation phase, and second is your withdrawal phase. Okay. So when you're looking at accumulation phase, which is next 10 years, right? Because you have a longer time frame, you should invest in equity as an asset class, because that will give you a slightly higher return than traditional investment asset allocation. Once you approach us towards the near of your goal, then again you need to rebalance your portfolio, and then you have to think that when you come to withdrawal stage, the first 3 years of a withdrawal, what we're going to withdraw, that should be completely in debt asset. The 3rd to 7th year withdrawal should be something in a hybrid asset, which is a mix of debt and equity. And the money which you require after 7 years, that can still remain in equity because they still have a 7 years time frame to grow that money.
All right, thank you so much for asking your question. On that note, I think we can take another short break, a great conversation around the fundamentals of asset allocation. When we return, the floor is open to the employees here at FIS to ask any questions they have to our financial planning experts. And remember, stay updated with us on our website, nsefinwiz.com, and our Twitter and Facebook handle at NSE Stay tuned, we'll be right back. Welcome back to NSE FinWiz Season 6, brought to you by CNBC TV 18. Well, the floor is open now to the employees here at FIS to ask any questions they have on financial planning to our experts here. So let's see a show of hands. Let me start with the back. The gentleman in the brown shirt, if you could get up.
NPS is like a good investment opportunity which is recently introduced as part of a tax packet as well. And I just wanted to compare what would be the returns of NPS against the equity mutual fund in the long terms.
NPS is a very good investment option. The primary reason is that apart from 1,50,000 under Section 80C, you get additional tax saving and up to 50,000 rupees in NPS till now. So that's an additional 50,000 saving of tax saving. So if you belong to 30% tax bracket, effectively a straightforward saving 15,000 rupees on the taxation. Secondly, from a return perspective, in NPS, you need to decide your asset allocation. So they have two options. One is called as auto and one is called as manual. In auto, basically the asset allocation changes as per your age. So as your age increases, your component to debt increases and component to equity keeps on coming down. And if you select manual option where you can decide your asset allocation, broadly if I look at the maximum allocation which you can go in NPS after 35 years of age is 50% equity and remaining in debt. So in the long term, obviously the equity mutual fund may outperform NPS, but again you have to look this not from a pure comparing equity mutual fund to an NPS. Is it because right now you're saving additional 15,000 rupees tax, which you won't be saving in equity mutual fund. It's not a guaranteed return because the return on NPS will depend on what the market return is there.
All right, let's see someone in the front row, the lady here in the first row.
My question to the panel is more on the unlisted securities. Like as a retail investor, should I invest in unlisted securities through authorized brokers?
See, the unlisted security space is actually bound by a lot of ambiguity. My suggestion would be that you, as a retail investor, follow the more conventional and the popular way of mutual funds. Or if you are really well researched, you have time on your hand, and you have the knowledge to pick stocks, then even direct stock picking of good, fundamental sound stocks could be done. But on a simple note, as a retail investor, I would suggest people, more or less, if you don't have the capacity to take a very high degree of risk, stay away from the unlisted security space.
Thank you.
Thank you so much for asking a question. Let's see the middle row, the gentleman in the white shirt there.
I'm always confused whether I should repay my home loan or put into the SIP. It's always a question because I feel the debt is again a big risk for me, though I'm backed with the term plans and all that. Should I have that risk and or remove that complete debt and then go for this investment, or vice versa, or
That's
I should have something a balanced one? Yeah.
First of all, as I told, home loan is a very good loan. Okay, first you should take it when you're buying a home, right? Second thing is, should I repay the home loan, right? Now again, you have two options here. One option is that if my loan cost is somewhere around 8.4% to 8.5%, right? So if my cost of borrowing is 8.4%, and on that I get tax benefit over and above that. Second option is that instead of repaying the home loan, I will rather recommend that invest that money in a pure diversified equity fund. And have a time frame of 5 to 7 years.
Thank you.
Thank you so much for asking a question. The gentleman here who got up, I think you can ask your question now.
How do I spot the right advisor? How do I spot the right planner? Something which is called like fee-only advisors. So is there any accreditation or some kind of tag which is certified and given to those consultant by CB, NSE, or is there anything using which I can identify, okay, I can go to this guy?
SEBI has got a registered investment advisor, which are called RIAs. And those RIAs come with a lot of, compliances attached to them. If they are able to match those compliances, then only are they allowed to practice. And they are fiduciaries. So keeping the client interest first is of paramount importance. These people presently are on a fee-only basis. Then you have a person who has to disclose, an RIA who has to disclose candidly at the beginning of the engagement that he is a fees and commission advisor also. Now this is one part of the story. There is nothing wrong with the IFAs or the CFPs who are not registered with SEBI as RIAs. The one mantra when you are selecting a good advisor is, in your meeting with him, find out, try to probe that is he looking at your investments in terms of achieving your goals, or is he only talking about returns? You will be able to differentiate the person.
All right, with that, we'll wrap up this episode. I'd like to thank the employees at FIS for a very interesting exchange of ideas that they've had with our experts. Of course, I'd like to thank them as well for sharing their insights. And thank you to our viewers for tuning in. We'll be back with another episode on another important topic around financial planning and wealth creation. Keep watching CNBC TV 18.
I would like to thank CNBC TV 18 for conducting NSE FinWiz Season 6 over at FIS Pune. It helped young professionals like me understand the basics of financial planning, which will help us achieve our financial goals in the long term.
It was a great event, I would say, and with a lot of enlightenment. I do an investment, but I know that I wasn't doing it right after this session. A lot of things that I need to go look back and correct myself. Definitely my investment was based on the returns. Now I would made it goal-based.
I think it was a great event and very good knowledge for all the participants from FIS. I would say from the experts, the knowledge, the questions and the queries answered were very useful. Personally for me, I think it was very beneficial because I got an answer to a question that was rolling in my mind for a couple of weeks now.
The event, the session, it was quite enlightening session and I don't have much more experience. I come from an IT background, so basically I don't have that much exposure into this. So got to learn many new things and related to the investments, what we have to do to get the diversified portfolios.
After the series and the expert opinions and the tips, I now will change the way I look at ULIP. I look at the traditional ways of making investments. So I'll now look into equity, mutual funds and whatever we discussed in the show.